Hello there, this is James, and you're watching a brand new educational series I like to call Trading Bites. Now, the reason why I call it Trading Bites is because it's more like a sort of like a mouth-sized piece of education. Obviously, you get the full package with the webinar series we're doing, a lot more detail, but it just gives you a little bit of a taster. And in today's episode, I want to discuss a subject which is very close to my heart, something which I learned when I first started off trading, which is obviously fundamental analysis. But before we get into all of that, don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research and do your own due diligence, and of course, know the risks of hand before entering any trade. With that out of the way, let's get started. So, yes, this little Trading Bites episode is about fundamental analysis. And the first question for everybody starting off on their trading journey is going to be, what is, of course, fundamental analysis? What is it? What's it all about? What does that mean? Well, fundamental analysis is used to determine the real or fair value of an asset. What does that mean? What does that mean? Well, with fundamental analysis, investors look for an asset trading at prices lower or higher than its real value. In other words, they dig deep to find out how much something is actually really worth. Because don't forget, the market is made up of people who buy stuff or buy assets for personal use or for investment, and then those out there who speculate on prices. So fundamental analysis all about finding out what something is actually really worth. Now, if the real value is higher than the current market price, this is what people use fundamental analysis does this. If the real value is higher than the current market price, it is then considered undervalued. And this could present a buying opportunity. So in other words, if an investor does their research into a particular asset and think, well, it's trading at this level at the moment, but it's actually really worth this could be a good opportunity to buy. On the flip side of that, if a real value is lower than the current market price, it is considered overvalued and could present a potential selling opportunity. So again, if an asset is trading at this level, but those who use fundamental analysis does their research, does their digging, and say, really, to be honest, it's really worth this price, that presents a selling opportunity or potential selling opportunity, obviously. So let's go through the different asset classes, how those who use fundamental analysis looks at different assets. Let's start off with, say, currencies, which obviously is one of the most traded assets on the market. The most liquid is obviously Forex. Now, here's a question I always ask, and it's, I can break it, it's simple to break down, but it's always something which is, in your mind. And it just take for example, the most popular or the most traded currency pair, which is the euro versus the US dollar. Okay. Now, both the dollar and the euro are made from the same bit of paper. They are, aren't they? There's nothing different between the paper realistically made, what the dollar is made from, or the euro is made from. I know we don't use paper currencies as much as we used to, it's now all electronic, but bear with me as I try and break this down. But not one bit of paper is made out of leaded with gold or silver or anything like that. It's still a bit of paper. It's the same paper made from each other. So what makes one currency more valuable than another currency? And this is where fundamental analysis comes in many, many ways with this. Because when you're trading currencies, fundamental analysis tries to estimate the future condition of an economy. What do I mean by that? So in other words, the reason why one currency may fluctuate or may have the value be more valuable than the other is that when you look at it, one country's economy may be more prosperous or have more of a economic future or more successful economic future than the other one. So this is what currency traders look at. They look at how is Europe doing or the EU doing compared to US. Is the US economy performing well, or is Europe's economy performing well? And this is how they try and balance it. This is what they use and they look into. Which country is doing better? Again, like say, I'll bring it down to forget the EU. I'll move it down to the British pound, for example. Is the UK? How's the UK economy performing against the US? Is it expected to grow faster than the US or slower than the US, which obviously will have a negative impact on that currency. So again, he's looking for the intrinsic or true value of that asset. Now, those who trade currencies, or those who are fundamental traders, to try and look at the fundamentals, they tend to use key economic indicators. Okay, key economic indicators. And when you go onto your trading platform or your trading chart, you will, often see a list of, a list of events happening during that week. It's usually on the financial calendar, which you can find on regular information websites, your trading platform, things like this. And it breaks down key events which could have an impact on the market. Obviously, traders and investors are looking at these events because they can impact on what a currency may do to another one. Again, looking at the intrinsic or real or fair value of that asset. And here's a few of a list of a couple of them. You have something like the gross domestic product, unemployment rate, retail sales, NFP, which we'll talk about in a second, consumer price index, average earnings, interest rate decisions, just to name just a couple. That's huge. If you go onto your trading platform, you'll see a big list of events. It often will have a red indicator saying these are the key events, because these are the most important, most likely or potentially have an impact on the market. Now, there are so many. We're not going to go through, obviously, all of them, but let's go through a couple of them to break it down. Now, unemployment rate and job growth. Now, obviously, sorry, I had a little sip of coffee. Sorry, probably getting a little bit dry. Anyway, unemployment rate and job growth. Now, this makes sense, okay, because if you have an increasing unemployment rate, This means that the number of people employed with money to spend can put into the system. Plus, those are the number of people who are also then reliant on having assistance from the government or from social insurance and unemployment benefit, which is a strain. So that's obviously not good for the economy. So again, fundamental analysis is devaluing the value of something, isn't it? Same as job growth. If you have a big increase in jobs, like more people are being employed, there's more jobs being created, that's a plus sign. Because again, it shows that your economy is growing and there's more people finding work. Again, more people finding work means they can put more money into the system, less the burden on the system. Big example of this, of course, one of the biggest events. To be fair, not as big as it used to be, but still pretty big, is obviously the NFP, the non-farm payroll, which is US job data, which is about US job growth, which is usually released on the first Friday of every new month. I probably will do maybe a small trading bites video on that. Not as big as it used to be, but it's still a key event. So that's something which is always something worth watching. But again, high NFP means the US, because it's US data I was talking about. Higher NFP sometimes tends to show that the US economy is growing and it can be beneficial for the US dollar. Other key economic indicators to look out for is retail sales. Now, the way the economy or our modern day economy is set up is all very, very reliant on us spending our hard-earned cash. Because again, it makes sense. The more money we spend, more money will pay workers who sells us the goods, who then goes back and pays the people who make the goods, and so on and so on and so on. Plus, at the same time, if we have more spare cash, we're going to spend more. So if we see a growth in retail sales, it's a positive for the economy. If we see a decline in retail sales, means people are getting nervous or they don't have as much loose capital to be able to spend their money, not a good sign. So that's why retail sales can be a key indicator as well. The other one, and this has been important over the last couple of years, those who watched me on my previous videos know I talk about this a lot. It's a big thing, and that's the Consumer Price Index, CPI. And basically, this can have a direct impact on the previous indicator I spoke about, which of course was retail sales. Consumer Price Index is the measure of the difference in the change of price of a basket of goods. What does that mean, James? Basically, it means inflation. How much the price of, say, a bottle of water has increased from the previous period. Is it more expensive to buy things? Is it more expensive to buy mobile phones, clothing, food, oil? And if we see the CPI rising up, then obviously people may stop spending more, putting pressure on the system. And that leads me to something else. And that's gross domestic product. Gross domestic product is basically the overall health of a nation. If you have a high GDP, that means the country is pretty healthy. It means it's doing okay. You see a decline in GDP, it means that country is struggling, hence it linking back to the potential future value of that currency. But all these things lead up to one thing, and that is interest rate decisions. Because interest rate decisions done by central banks is often based on all these factors: GDP, CPI, retail sales, job job growth and unemployment. Now, central banks tend to do two things. When things are good with the economy, things are growing, okay, and you've got a stable job market, you have good retail sales, you have good GDP, they tend to what's known as tighten. And what I mean by tighten is they increase interest rates. Reason why they do that is to fight consumer price index or inflation, because that tends to happen when things are good. Inflation tends to rise. Bring inflation down to stop people from spending and encourage people to save. So that's a good thing. That means that higher interest rates means that their economy, in their opinion, is doing quite well. And it's quite stable, so they can increase interest rates. And as well as that, when they raise interest rates, it also means they can encourage foreign investors to invest in their country to save their money, because more money, more back for their buck, so to speak, for the money they will invest, because they got higher interest rates in other countries. The other thing they tend to do when things are not so good, when unemployment is rising, for example, or manufacturing is decreasing, or retail sales are decreasing, or there's generally a slowdown in a number of things, they do the other thing, which is called loosening. And loosening is when they decrease interest rates. And the reason why they do this is trying to encourage you not to save your money, but to spend your money. But more importantly, trying to encourage you and banks and businesses to borrow money, because it's cheaper to borrow at low interest rates, obviously, because you pay less on interest rates. So they're trying to get you to borrow more. Hence, the belief is that they will inject money back into the economy to boost it. Now, fundamentally speaking, if you have higher interest rates, means it's a good sign. Fundamentally speaking, I'm not talking about what's happened over the last year. Fundamentally speaking, it's a good sign because it means the economy is strong. So it means technically, in theory-wise, fundamentally, that currency should be stronger. Lower interest rates. Lowering interest rates means that the economy is struggling. So that currency could or should be potentially weaker. So that's in a nutshell with currencies, but let's move on to stocks. And when we do that, if you don't mind having a little drink, because my voice is my throat's getting dry. Stocks are very different because you have two different theories are looking at the fundamentals when it comes to stocks. Currencies, okay, you look at the country involved, the economy, the this and that, and it's very technical based. But stocks, I tend to feel it's a bit more fundamentally driven. Okay, but there's two different types of theory behind when you look at stocks. The first one is qualitative. Now, this is the information which can be gathered by using numbers, figures, ratios, or mathematical formulas. Sorry. So we have qualitative. Okay, so it's numbers based. It's numbers. Okay, and I will explain a little bit more what I mean by that. The other one is qualitative. Now, this means the actual quality of the company or the company's service or products. Let's break this down a little bit more and go into a bit more what I mean by that, because it sounds, what's that? Let's break it down. Because realistically, like you do with fundamentals with currencies, stock fundamentals look to identify a company's value or worth as a business. let's go through this a bit. So let's start off with the first one, qualitative. What does it look for? What are things they look for? Remember, we're looking at numbers. Okay, numbers. So with this type of analysis, you look at stuff like earning reports, which is huge. It comes out every quarter. It's a big thing in the market. You always hear about the earnings report, massive. But there's other things that those who use this formula of analysis look for. They look for stuff like revenue, profit, asset, financial statements, the actual what the company is actually doing, how the company is actually performing, to see what the real, again, the real or fair value is. The other thing they look at is growth. The size of the workforce. Is it increasing or decreasing? At the moment, as we know, for example, Google, Facebook, Microsoft, they've laid off a number of people. So again, that sort of thing. That's currently what's happening at the moment. But again, they look at the workforce, because if a company is earning or growing and taking on more and more staff, expanding, that's a good sign, right? So maybe the real value is, or if the workforce is being decreased, maybe the value of that company is not so good. They also look at, excuse me, earnings per share. You know, what's the growth in the share value over the last quarter or the last period of time, whichever they're trying to measure it at. Projected earnings, and how much of those earnings are going to grow over the next quarter or next period of time. They look at that as well. Again, these are all numbers. All numbers. Debt to equity ratio. How much is the company functioning, actually functioning and operating on the actual money generated? How much is it operating on the investment of the shareholders, its investors? Is it working on its profits? Is it breaking even, or is it surviving purely on its investment from its shareholders and other investors? So again, share numbers based. The flip side, of course, is the other one. Like I said, is the qualitative. And this is different because it's not so much number based. Instead, it looks past the numbers, but it looks at other things, like key executives. Who's running the show? Who's the guy with the brains, or the lady with the brains, should I say, or the person with the brains? Who's the individual running it? What experience and expertise do they have to bring to the table? How well known is the company? Brand awareness. Are they a well-known brand? Are they, like Apple, Samsung, Nike, Reebok? Sure, what I am saying, Reebok. You know what I mean? So how identifiable are they? Patents. What latest technology do they have the right over? Latest gizmo or this? And technology, what technology they're using? They're ahead of the curve, their competition. And it goes on to how they operate their business model. How are they structured? How are they going to operate in the next quarter? What's their, how is the general day-to-day operations of that organization? Competition. Who are they up against? How's the competition doing in the marketplace? How well is, again, I'm going to use Samsung and Apple. How well is Samsung doing against Apple? Is Samsung taking up the lion's share, or was Apple taking up the lion's share? What else? Or are their competition failing? Because sometimes you can find companies where their competition fails first or starts to fail first, which can then indicate that they will start doing the same because the market has changed. So competition, who are they competing against and how well are they performing? Management. Again, this goes pretty much very similar down to the executives, but who's running the show? Who's in charge? You got Elon Musk, a very bright, clearly very bright individual. Is he leading the show with new ideas, or you've got somebody who you don't know of, somebody with no track record? I've seen companies share prices drop all of a sudden with announcement of people leaving. So management, who's in charge, who's running the show, who's guiding the way. There's a big difference between a manager and a leader. Who's leading it? And do they have the right vision? So management, again, it's these things that people look into to understand, again, to identify the real value of an asset. Economic situation, of course, that makes sense. Because again, if we just go on to the practical purchasing of stuff, the phones again, if we're going through a tough time, we might not all have the money to be able to buy phones. Simple as that. Just using that as an analogy. At the same time, as we mentioned already, downsizing or hiring, how's it all going? Plus, when it comes to stocks and shares, as they are a risky investment, people might not have the money to invest on the stock market as well, which means fluctuation. Liquidity is less. So again, look at the economic situation as well. Is there a market for people to buy? Again, I'm using smartphones because it's the easiest comparison. To buy Apple phones, is there a market? Have people got spare cash to buy Apple? We saw something back last year. Okay, I'm going to date this because this is an education video, obviously on the site. Back in 2022, when Apple's flagship didn't do as well as they did. Reason why? Because the economic situation wasn't good. People didn't have spare money to at that time. So these are the things you need to take into account as well. Economic situation. It sounds scary. There's so much to take in, but trust me, bit by bit, you digest it. It'll come like second nature to you, so don't get scared. Right, moving on to commodities. It's slightly different because commodities, excuse me, is more about supply and demand. Supply and demand. What do I mean by that? Well, let's go through some examples. First of all, oil. Oil. One of probably the most famous, most used commodity there is. How many things is oil used for? Let's break down this list. First of all, we all know it. It drives our cars, our airplanes, our trucks, stuff. Heats buildings, electricity, industry, plastics, solvents, lipstick. Not like no, but it's used for so much. But obviously, automatically we think of industry, vehicles, planes, things like electricity, things like this. Now, how oil prices can be affected can be supply. How much oil is there available on the market? How many barrels of oil is OPEC going to put out there? If we see it cutting production, then clearly that's going to have a potentially effect on the oil prices because supply is less. Or if you have, say, for example, a number of oil rigs in the Gulf of Mexico gets wiped out by a horrendous hurricane. Again, that could potentially impact supply. So there'd be less oil on the market. We saw this back in 2022 with the Ukraine war. Was that happened? There was a big issue with the supply of oil because of obviously embargoes on Russia, which affected the price of oil because there's less supply. So less of something can affect the price of it because there's less of it available, so it makes it more expensive. Which then leads you obviously to demand. Now, if, for example, I'm a country or I'm a president of a country, my demand of something is beginning to, my economy is slowing down. I don't have so much demand for oil. So demand starts to dry up. That can impact the price. For example, China is the biggest purchaser or use of oil. They have a huge industry, huge manufacturing. You all know it's that massive, okay? They had a massive lockdown back in 2022 because of their zero tolerance policy to COVID-19, which means demand for the manufacturing and things like that decreased, which meant the demand for oil decreased. So that can have an impact. Let's do another example of a commodity. And this is going to be really funny. I'm going to have one more sip of my drink for this. Because I'm West Country, I have an accent. So example is copper. Copper. Okay. It's called the red metal. It's an industrial metal. What it's used for? It's used for electrical equipment, wiring, plumbing, etc. Okay. Now, copper. Sorry, I laugh because I can hear myself and it sounds really funny. I know it does. Is, like I say, industrial manufacturing. So you have growth in industry and manufacturing side of things, and copper is obviously going to be in demand. If you see a decline in industry and manufacturing growth, then copper, or I'm just going to say the red metal, it's easier, is going to suffer. So that's another thing to bear in mind. Let's go on to some soft commodities as well. Let's go on to sugar. Now, sugar is used, obviously, it's been tea, if you're a tea drinker or coffee drinker, sweetener, preservatives, flavoring, coloring agents, etc., etc., etc. Different thing with soft commodities. You can say this with cocoa, you can say this with soya, you can say this with wheat, which is a really good example, actually. Wheat, again, is supply. So this sort of thing, you look at sort of harvests, how the harvest is built. And don't forget, you have a load of harvest reports out there, which is free for you to get access to. So if they have a bad harvest of cocoa, could affect the price of cocoa in the future. So these are the sort of things you can take in and absorb, again, to find the real intrinsic value of something. And the reason why I say that, so wheat, for example, don't forget, Ukraine again, it's nothing to do with a harvest. This is obviously conflict. Big supplier of wheat, war cut off costs. That's why wheat prices went up. So these are all the sort of things you can use to take into account your fundamental analysis. But yeah, anyway, going back onto my original point with harvests, it's always, you can do that with soft commodities, and I do like soft commodities. So yeah, again, this information is out there, so you can read it and see it, find out how good the sugar crop's been or this crop's been for you to help bring in some ways, what the supply's like, and then you can see what the demand's like as well. So again, that's fundamental analysis. Finally, I'm going to have to bring this up. I have to. People who know me and watch me, they know this. Gold. Gold. Metal. I love my precious metals, gold in particular. It's my first love when it came to trading. I talk about it a lot. But gold is slightly different. Yes, it's used for manufacturing, it's used for technology, it's used for computers, it's used for something else. But it's a store of wealth. Why? Because when things are bad and the chips are down and people are nervous, people move their money into gold as a safe haven. So when you have economic strife or concerns of conflict, gold gets its attraction back. Gold gets its little shine. Yellow metal ends up being quite attractive to investors. Store of wealth. So again, how good is the current economic climate, sorry, shall I say? How good is political affairs? That's another thing with gold, and I love that. And I've been training gold for years, and that's the thing about gold. So I have to bring that up. And don't forget, obviously, gold and oil are part of a very exclusive club called the Commodity Currency Club, which means gold and oil prices can affect the likes of Australia, South Africa, believe it or not, Norway, and Canada. Why? Well, Australia and South Africa are the two biggest producers of gold. So you have a high gold prices can affect the currency price of the Australian dollar and the rand. And Canada and Norway, or NOK, or Norway in particular, are very big oil producers. So high oil prices can affect the value of the loonie or the Canadian dollar and the NOK. So they're part of that exclusive club. Anywho, there we go. There's a little bit of the episode of Trading Bites, a little breakdown on fundamental analysis, more of a little chat and a talk about it, really. Don't forget, this is just a bite-sized piece. When we do webinars or do our webinar series or for other courses, you can get a lot more into it. But this is more of a case of an introduction to it. I hope you found it interesting and useful, and you put up with me being so passionate about this particular subject. Anywho, till the next topic or next time. Don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research, do your diligence, and of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.